Hi, welcome back to the channel. My name's Phil and this is Grow Your Dough. This video is specifically targeted at people who know nothing about investing, or maybe new investors, or maybe existing investors who want to learn a little bit more about a rigorous approach to picking stocks. By the end of the video, I hope you'll feel more confident about picking winning stocks for the region that you live in, wherever you are in the world. So let's crack on with it. Firstly, I want to say to you, whenever you begin a task, be that opening a can of beans, chopping some firewood, straightening your hair, traveling large distances, we use tools to help us make the task easier, to turn something that is complex and difficult into a more simplistic activity. And usually it helps us save time too. So today we're going to be talking a little bit about businesses. And before I dive in, I want to reassure you, if you're not an accountant, if you haven't studied business studies, if you haven't run your own business, don't worry. I want to promise you, it doesn't matter. It doesn't matter. One of the biggest barriers to entry to starting off in the stock market is all of the technical jargon and all of the complicated stuff that you need, or you think you need, to understand to be able to make an assessment of what is a good business. Well, today I'm hoping to demonstrate that you don't have to know all of those things to be a successful investor in the stock market. With those acknowledgements in place, let's look at the 4 key questions an investor needs to ask before they actually buy a share of a company. Question number 1. Is this a high quality company? But what does a high quality company mean? From a business perspective, it means, can this company continually generate profits that can be shared out to their shareholders over the longer term? Can this company demand a premium price for their product or service? Is the company stable, or is it at risk of bankruptcy? Are all of these qualities that I've defined improving or declining? That will help us decide whether this company is a quality company. But how do you assess those parameters that we've defined? So traditionally, an accountant or someone with business knowledge would be able to pour through the financial data that every company is required to produce every quarter. And from that data, they'd be able to assess certain qualities about this company. So that means you'd need accountancy knowledge. You'd also need some business knowledge to be able to compare the figures for company A in a sector against company B in the same sector. Which one is a better quality company? So is McDonald's a higher quality restaurant chain than KFC, for example? It takes a lot of work and a lot of knowledge to be able to assess that sort of information. I don't know about you, but personally, I don't have the inclination to pull through lots of financial data for lots of different companies. It's not what floats my boat. The argument for choosing to invest in high quality companies is that evidence suggests that if you buy a set of high quality companies as a basket of stocks to invest in, they perform better than if you buy a basket of low quality stocks. So that's why we're interested in whether the company has high quality. The second question we need to ask: does the price that I'm being asked to pay for a share in this company represent good value? So is it cheap or is it expensive? It's all very well finding a very high quality company, but we're investing in this company in order to make money. And if we're being asked to pay a really, really high price to buy our share, then the chances of that price increasing again are reduced. That's why we prefer stocks that are cheap rather than expensive. There are many ways to consider whether a stock is expensive. You can compare the price that you're being asked to pay for the share against the amount of sales the company makes, or against the amount of profit a company makes, or against the amount of cash that a company generates. Each of these is recognized as a way of valuing a company. But again, to assess this information, you'd need to be able to look at a balance sheet of a company, the financial data that's produced on a quarterly basis, in order to evaluate and assess that data. Also, you'd need to be able to compare it against similar companies operating in a similar field. Again, like the 2 restaurants I said earlier, McDonald's and KFC. Which one offers better value in the restaurant industry? And the argument for choosing cheap companies is they perform better over the longer term if you buy a basket of cheap stocks than if you buy a basket of expensive stocks. That's what the research tends to suggest. So the third question that we can consider asking ourselves is, are other people starting to notice the potential of this investment? And when I talk about other people, I want to break that down into two camps. The first camp is the analysts. The analysts are financial professionals who perform extensive research on companies, the industries and the sectors that they work in. They produce research material which investors can then buy and use in their evaluation whether to buy a particular investment or not. Part of the data they produce is projections for each company of what they think their future profits will be. If several analysts positively update their projections for profits for a company, then this suggests that the company is a more attractive investment, as they are suggesting it's going to generate more profits and as a result offer better value. The second group is the investing community, the individuals and organizations who actually buy stocks and shares. And the investing community is broken down into two sections too. There's the institutional investors such as pension funds, insurance companies, finance houses, and then there's the smaller investors like you and me, who are known as retail investors. When the investing community starts to respond positively to a company, they go out and buy the stock. And as a result, the share price rises. So when I ask, are other people starting to notice the prospects for the company? I'm looking for an increase in earnings momentum, the projections provided by the analysts, and an appreciation or a rising share price. That's the investing community investing and buying the stock. The argument for choosing stocks that show strong momentum in this way is that if you buy a basket of these stocks, they tend to outperform a basket of stocks exhibiting low momentum. The fourth question is the company growing? So great care needs to be taken here, as companies that have explosive growth are often severely punished if they fail to deliver it. These companies come with very expensive price tags and they have huge expectations upon them. Any slip up in the execution of the delivery of their promises can be really punished harshly by the market. So when considering growth, it can be useful to look at historic growth figures. How successfully has the company grown in the past? And what are the projections looking like for the company going forward? So now we have four factors to consider: the quality of the company, the value of the company, the momentum of the company, and finally the growth of the company. So we know the four questions to ask, but I guess you're sat there thinking, how on earth do I assess the quality, value, momentum and growth of a company? I don't have the skills, I don't have the data, I don't have the ability to analyze this information. That's okay, because neither do I. Rather than working harder at investing, I've learned to work smarter. I've learned to use tools that help me to evaluate the quality, value, momentum and growth potentials of a company, and they help me to do it in an instant. It's like having an accountant sat on my shoulder, instantly analyzing a company for me. I use a web-based service called Stockopedia that has all of the data about all of the companies as they publish their financial information. Stockopedia analyzes every company and produces a rank for each of those four questions that we asked earlier. They produce a quality rank, a value rank, a momentum rank, and a growth rank, scoring from 0 to 100, with the worst companies being 0 and the best companies being 100. And they provide a way for me to screen and filter all of the companies in my investment universe. So maybe that's the UK if you're in the UK, or Europe, or America, or India, developed Asia, Australasia. And you can pick out the companies that have the best quality, that have the best value, that have the best momentum, or have the best growth. Maybe we're looking for the companies with the best quality and momentum, or the best quality and value. Stockopedia do all of that for us. So for example, Apple, the American technology company, has a quality rank of 93, a value rank of 29, and a momentum rank of 77. So Apple is a high quality company that has good momentum, but is relatively expensive. And you're able to work that out in an instant just by looking at what is called a stock report. Ed Croft, the CEO of Stockopedia, attempted to classify the profiles of winning and losing stocks. Ed highlighted 8 combinations of quality, value and momentum, which produced 4 winning profiles and 4 losing profiles for companies when you invest in the stock market. Let's go through them now. So stocks that score highly in quality, value and momentum are called super stocks, and they're a triple threat. They are a high quality company, they're inexpensive, and the wider investing community has a positive sentiment towards them, increasing profit estimates, and the share price is appreciating too. Contrarian stocks have high quality and high value but low momentum. They're called contrarian stocks because an investor who invests in this type of stock has spotted something that the wider market has yet to notice. That's why it's got low momentum. They're prepared to invest in this stock contrary to the opinion of the wider market, in the belief that the market will eventually catch up with their investment hypothesis. High flyers are a combination of high quality and high momentum but low value. They're expensive. As long as these stocks keep delivering, they can continue trending with their momentum for extended periods of time. Turnarounds are cheap companies that the market has started to notice. Analysts are increasing their profit forecasts for the company, and the wider investing community has started to spot the potential in these companies too. Perhaps they've had some historical disruption to their business model. Maybe a competitor launched a new product, or some sort of environmental factor damaged their business, and the management team has had to rebuild their company. Hence, that's why it's a turnaround. It's found itself in a difficult situation, but the management team has responded and the company's starting to come back into form. So that's your 4 winning profiles. Super stocks, high quality, high value, high momentum. High flyers, high quality, high momentum but expensive. Contrarians, high quality companies that are cheap but have not yet been spotted by the wider market. And turnarounds, cheap companies who are starting to recover and re-establish themselves. Let's look at the losing profiles now. So a company that has high quality but is expensive and has no momentum is called a falling star. Despite having a high quality business model, they've fallen out of favour with the wider investing community, and they're expensive. High flyers can turn into falling stars when they fail to deliver on the earnings expectations that have been predicted for them. The second losing profile is a value trap. This company seems really cheap, but it has no momentum, the investing community is not interested, and it's a low quality business. It doesn't make much profits on its products. Whilst it might seem like a bargain, the share is going nowhere. A glamour trap has high momentum. The share price is skyrocketing. Maybe analysts are predicting future growth for the company, but actually the company has a really poor business model and the company is eye-wateringly expensive. As the share price continues to appreciate, the company gets more and more expensive. The momentum rank keeps increasing until eventually the bubble bursts and the price drops like a stone. Finally, sucker stocks have no redeeming features. They're expensive, they have a poor quality business model, and the wider investing community just isn't interested in them at all. Yet you will still find people investing in sucker stocks. That's not to say that some sucker stocks won't go on and double and quadruple in price, but if you're buying and fishing in this pond regularly, you're probably going to lose a lot of money. So there we are. You've got a set of winning profiles and a set of losing profiles based around the quality, value and momentum of a company. And what I'm trying to do is help you select stocks from the winning profiles. It's better to invest in companies that score highly in a combination of these factors. So Stockopedia have mixed together one recipe for us already, and that's to mix quality rank, value rank and momentum rank to produce an overall stock rank score for each company. And when you look at the stock report for Apple, you can see that its stock rank is 75. That means when you look at the American market, Apple is in the top 25% of companies when you rank them by quality, value and momentum. So as I mentioned earlier, Stockopedia provides screening services that allow me to filter the whole investment universe based around lots of parameters. And I can filter the stocks based on any of those ranks that I've talked about to find the companies that fit the criteria that I'm looking for. So what I've done is I've done some research into which of these particular approaches works best for each region, and I provided some data. So Stockopedia has been tracking some portfolios based around these strategies for 8 years in the case of the UK. And what you can see is that over the 8-year period, portfolios built using a high flyer strategy, which is high quality and high momentum, have returned 385%. And when you annualize that, that's a 22% gain per year, which is just remarkable, really. When these portfolios are built, automatically Stockopedia, they select 25 stocks. And when this approach is used with a high flyer strategy, on average, it picks companies which have a stock rank of 94. The next best strategy is value and momentum, turnaround companies, generating 379% or 22% annualized over the 8-year period. And stock rank, which is the quality, value and momentum rank, returns 296% or 19% annualized. And that's compared to the FTSE, which has returned 23% over the same period or 3% annualized. I just want to do some maths quickly for you. So if I had an initial investment of £1,000, let's make that pounds, and the gain over the 8 years is equal to £1,000 multiplied by the return. So that's the gain. And then the total equals the sum of those two. So it's that plus that. So £1,000 invested in a high flyer strategy will have turned £1,000 into 4,850 in 8 years' time. It's just remarkable. £10,000, £48,000. So that's why I'm trying to encourage people to get investing in the stock market. It doesn't have to be large sums of money. It doesn't have to be all of the money that you have saved or any savings you have, but benefiting from this sort of compound interest is remarkable. Okay, so that's the UK. Let's look at some other areas now and see how the performance relates there. So the best at the moment in the UK is 22% annualized. Okay, so here we are in Europe now. Similarly, 8 years worth of data. High flyer, high quality, high momentum has returned 434%, annualized return of 24%. Turnaround companies again, 407% for an annualized return of 23%. And the stock rank system, high quality, high value, high momentum, 386% or 22% annualized. These figures are just remarkable in terms of the annualized rate of return. Okay. The FTSE Euro First 300 over the same period returned 50% or 12% annualized, which is good. 12% annualized is good too. Okay, so in Australasia, which is Australia and New Zealand and those sorts of areas, high flyer is the best performer in that area too. This is only over 5 years. It's 133%, but still 18% annualized is excellent. Compared to the S&P Australia Exchange, 41%, an annualized return of 7%. Another really good performance. So looking at India now, in India the best performer is a contrarian approach, QV, high quality, high value, and that's returned 252% over 5 years, annualized at 28%, remarkable. Stock rank again, high quality, high value, high momentum, 252% or 28% annualized. And high flyer, high quality, high momentum, 181%, 22% annualized. And the underlying index has returned 95% over 5 years, an annualized rate of 14%. So again, excellent. These figures of annualized return to 28% are just remarkable. Developed Asia, which includes China, Japan, Korea, 5.1 years worth of data. Stock rank is the best performer. High quality, high value, high momentum, 140% annualized, 19% per year, compared to the Developed Asia index, which is 50% over that 5 years, annualized 8%. And in Canada, again, 5 years worth of data. Turnarounds are the best performers, 317%, an annualized return of 32%. And so you may be wondering, why hasn't Phil put anything in about America yet? You can see it on the sheet at the bottom. Okay, so America is a bit of an interesting market. It seems that the stock rank system doesn't work as well in America as it does in other markets. There's some reasons why that might be. It seems that the American markets are much more efficient. So when data comes out from companies, it's analyzed really quickly and distributed to the market. And before any anomalies in terms of discrepancies between the data produced by the companies and how much you're being asked to pay for them is allowed to arise, it's already corrected. So value opportunities disappear. Quality is priced in. Momentum jumps before you can react. However, the US market seems to heavily tilt towards growth. It likes growth companies. So let's look at the figures for the American market using growth rank. So here we are looking at the American data. And again, this data is collected over about 7 years. The best performer is growth rank on its own, 291%, 24% annualized, which is excellent. Momentum rank on its own, 183%, 18% annualized, which again is fantastic. But we know that investing in just one factor on its own presents risks. So really, we don't want to invest in just a growth rank or a momentum rank. We want to blend a few of the ranks to give us some extra security, so there's more behind the company than just one factor. And so the GM rank, which we haven't talked about yet, is the growth and momentum rank. It's a combination of these two ranks. And over the last 7 years, it's returned 177%, an annualized return of 16%. And I've put an estimate in here because I've had to estimate what I think the stock rank is, because although Stockopedia tracks this data for the GM rank, it doesn't present it as much as it does for the other ranks. The S&P 500 during that period has returned 104% or a 12% annualized return. The risk with growth companies is that you end up overpaying for the growth that's being offered. And you can't use the traditional methods that underpin the value rank to value growth companies. You need to use another ratio. So what I'll probably seek to do going forward is build a custom screen that looks at the growth and momentum rank and also folds in some value measure that evaluates the price I'm paying for the growth that's being offered. So it's simple. I decide how much money I want to invest, which markets I want to invest in, which strategies work best for those markets. I run the screener to select the stocks from those markets, and I allocate my funds to the stocks that are at the top of those screens. And my investment strategy document, which I've covered in other videos, you can see it up here if you look it up here, will describe how and when I come to sell those stocks. If you want to see how this works in practice, I've already gone through the process of screening, allocating and buying a UK-based portfolio based around stock rank, the high quality, high value and high momentum ranking system from Stockopedia. And if you want to see how that's done, have a look at the link I'm posting to up here. I recently posted a review a month on from forming that portfolio, and I'll be tracking that progress as we go forward. In future videos, I'll be taking the information that I've presented here and building portfolios using the same sort of strategy in other markets. I'll be looking to use other strategies in the UK too that have worked well. And hopefully over time, you will see a transparent set of videos that demonstrate how I select stocks, how I allocate them and how I track them over time. And hopefully the performance will be fantastic and you'll get to see the evidence of that process. No whistles, no bells, no secrets. So for me, using the Stockopedia service is like having an accountant sat on my shoulder who can instantly evaluate a company's profile in terms of quality, value, momentum and growth. It's fantastic. Saves me time, hassle, and allows me to screen for companies that fit criteria that I'm looking for. It helps me evaluate which criteria work well in which countries too. In practical terms, I can screen and buy a set of 20 stocks in under an hour to build a portfolio. It's just fantastic. So if you like the look of Stockopedia, then I've included a referral link in the description below. If you sign up for the service using the link, you'll get 25% discount when you sign up for an annual plan. That includes a 14-day free trial and a 30-day money-back guarantee. It's a referral link, so I'll receive a fee if you sign up to the service, and that referral fee helps me to really support and grow this channel. If you enjoy the content that I'm providing today, please give me a thumbs up down below. It really helps. You could consider subscribing to the channel if you think that this information is going to be useful to you going forward and you want to track the progress of the portfolios I build. Please, if there's any questions you want answered, just leave a comment below and I'll be happy to do my best to answer them for you. So in closing, I hope I've really helped you to understand there's 4 key questions that you need to ask when thinking about buying a company. Is it a high quality company? Is this company expensive or cheap? Are other people starting to notice the prospects for this company? Is this company growing? I've highlighted tools that can help you to evaluate those questions. And you've learned what are the profiles of winning stocks and what are the profiles of losing stocks. and I've also highlighted the strategies that work best in different regions around the world. So that's it for today's video. Thanks for watching, and I hope to see you again soon. Bye.